Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of LME 3-month lead and tin. I'll start with LME 3-month lead itself. Now, the juddering rise from the lows back in May pushed up through the congestion and trend lines, plus the middle time, currently at 1762, of the March to April bearish shift pitchfork. This pitchfork has, and still is, super significant, as it was back then the combination of the 50% Fibonacci line of the June to October 2018 move at 22.21 and the upper time, currently 1979, of this same March to April bearish shift pitchfork that capped the rise in late May stroke early June. And we subsequently saw prices move down and up and down, all the way down in between the lower time and the upper time. During the move lower, the market created another more recent pattern. Another bearish halfway hesitation, a fresh one. The question was whether the measure was from May high at 23.33 or the April high at 24.88. Well, it didn't matter, as eventually both targets below were reached and the market immediately turned back up with an uneven pipe bottom 2 weeks ago based on the middle time. Last week prices rose and tested the upper time, making intraday indecisive actions as prices went sideways, exiting through the upper time, though prevented from rising too far by the January 2020 high at 2039, and to a certain degree by the declining short-medium moving average, currently 2051. However, yesterday was the first day that the market was completely outside the bearish pitchfork. Admittedly, with an indecisive doji cross pattern, yet it was still outside, and that goes some way towards explaining today's action as an exploratory move higher, when there is no apparent resistance around until the January 2020 high at 2039. It is not perfect, and this market could easily turn back round down and decide to run along the top of the upper time, something I've seen done elsewhere. But for the moment, it has the opportunity to test higher, and it'll be interesting to see if the market takes up that opportunity. And therefore, I'll leave the bearish shift pitchfork on this daily chart just in case prices give up the chance to try higher and decide the ski slope of the upper time heading lower is a better idea. LME 3-month tin. Towards the end of June, prices here dipped heavily through congestion, notably the congestion band between 22,900 and 24,155 levels. This one has some interesting supports within significant levels. They are the July 2014 high at 23,070, the May 2014 high at 23,500, the April 2014 high at 23,855, the October 2013 high at 23,970, and the March 2013 high at 24,155. The dip made that day penetrated all of these, but failed to break through the actual bottom of this support, and instead reverted back up again. What was interesting about the move low was how it was the first, and so far only, open below the middle time, currently at 18,325, of the rather acute bearish Andrews pitchfork for the mid-April to early June action that I'd drawn a few weeks ago. Now, I had previously said of this bearish pitchfork, and I quote, "It is very acute and therefore likely unsustainable, but it gives an idea of what we may be looking for on the downside," end of quote. Thus, it seems an open below the middle time caused such a reaction in this market. Now, since that time, it initially looked like the market would be going roughly sideways with a bearish tinge, testing the congestion from February 2013 between 25,050 and 24,750. And the earlier mentioned detailed congestion between 24,155 and 22,900. However, the pattern has clarified into a bear channel, currently 24,680 down to 22,385. Prices have traveled down in this bear channel, but have gradually become constricted, because as we've traveled lower, we have been traveling sideways and have impacted two areas of impact. From above, we have the combination of the upper time, currently at 24,350, along with the short moving average, surprisingly, 25,170. Meanwhile, below, we have the detailed congestion between 24,155 and 22,900. And this market is the meat in the LME tin sandwich between those two. You see, the upper Tyne and the upper Bear channel line all cross over into the detailed congestion area below at the end of this week. Thus, to break them both, all that is needed is for the market to travel sideways. It is, as I've said these past weeks, and I quote, "It will now depend on who wins between the heavy-duty support and the bearish Andrews pitchfork." End of quote. I guess it was always going to come to this. One final point to be aware of. Please be aware that if you do so suddenly remove the bearish pressure that's been running the market lower for so long, obviously assuming the price tries going sideways, well, then you might just see a reactionary move back up, much like a horse being let loose in the field after the saddle has been removed. Thank you for listening. This weekly broadcast gives you essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright Eddie Tofpik and ADM Investor Services International Limited. And here comes the final bit.